Welcome back, everyone. Now we will be hearing about the market reports of ASM members. It's going to be in 2 sessions. The first 9 will take the stage right now, and after lunch, the second 9. So I would like to invite the first presenter from ASIFMA, Mr. Matthew Chan, to the stage to present the market report from Asia Securities Industry and Financial Markets Association. Before you begin, sir, I would like to make a reminder. Let's try to stay in line with our time limits, which is like 6 to 7 minutes per presenter. And you will have your timer in front of you, so I will not intrude. Please, the stage is yours. Thank you. Thank you.
How's that? Thanks, Ege, and also thanks to the Asia Securities Forum for having us and ASIFMA to present today, and also very grateful to our hosts, the TCMA, for hosting in your beautiful country with such beautiful weather. So thanks very much. For those of you that don't know me, I'm Matthew Chan. I look after public policy and regulatory affairs for ASIFMA. So I'm very focused on regulatory reform across the region. ASIFMA is a regional trade association, so we're looking at issues and challenges both within mature markets. So we on that front we focus on Hong Kong, Singapore, for example. We also focus on market development. So 2 of our key priority markets are China and India. And then by virtue of the fact that we're a regional organisation, we focus very much on cross-border issues. I'm only going to talk very thematically in my 6 minutes. I don't want to hold things up. I'm going to talk a little bit about what we've been doing in China at a very high level. I'm going to talk about market fragmentation, so regulatory-driven fragmentation and what we've been doing there and some of the challenges as we look at that as a lens through which we explore other issues across the region. I'll also be covering EU benchmark reform, so that's been a big challenge for many of our members, obviously outside the EU, and how they interact with the EU and what that means for the markets outside EU, including Asia. And then finally, I'll touch a little bit on Hong Kong. Okay, so from a China perspective, we've been very engaged with the Chinese regulators, so we're very much focused on market access issues. So from our members' point of view, which covers both asset managers as well as many of the banks, we've been looking at ownership rules issues. So a lot of the issues around licensing has been quite challenging, and there's been some positive improvements. But we're also looking at some of the unofficial inhibitors to firms looking to either operate in China or establish entities there. From an access point of view, we're very focused on some of the challenges around the different Connect schemes, so that's Bond Connect and Stock Connect. So there's a lot of tweaking involved in terms of making sure that those schemes work, and then operational issues when it comes to issues such as CNY versus CNH. And then, I guess from my perspective, I've been looking at regulatory issues. So making sure that when we're engaging with the Chinese regulators, while we understand their regulations are very much driven from a domestic policy perspective, also enabling them to understand what some of the implications might be from an international markets perspective. And then finally, within that category, we've been looking at data localization. I was going to bring along our white paper that we produced in June, but my luggage was getting too heavy. It's quite a hefty document, but really that's an opportunity that we've taken up in terms of, from an industry perspective, particularly from the perspective of international asset managers and banks, what are some of the challenges? And so it's well worth, if you haven't seen that document, speaking to me about how to get your hands on that. But it really covers all those kinds of issues. fixed income, equities, etc., listing out all the challenges and so on. Going forward, one of my priorities is to make sure that we're engaged at the right levels with the Chinese regulators, both at the working level, which we've been very successful at, but now moving to the more senior levels. Fragmentation. So that's another big challenge that we see and our members want us to be engaged in across the region. We've been very heavily engaged in terms of reaching out and working with the FSB, IOSCO, and also the Japan G20. So we're very grateful for the progress that we've made, not only in terms of highlighting what some of the issues are, whether it's around trade reporting issues and differences between different jurisdictions, or some of the derivatives regulation that have come out of the post-crisis reforms, but actually creating and embedding processes and means to deal with these issues in an ongoing way. So, for example, IOSCO has made a decision that they will be having an annual report prepared by the AMCC, the Affiliate Members Coordination Council, and that's an opportunity for associations and our members to actually talk about some of the fragmentation issues that we're seeing in Asia Pacific, and likewise in some of the regional committees. So ongoing processes and means for dealing with market fragmentation. But we also use that as a lens to look at other issues across the region. So some of the challenges that we're focused on and very, from our members' point of view, are seen as critical. Basel III, so the final implementation, so making sure that actually some of the challenges there are understood in terms of coordination, synchronicity between different jurisdictions. Data localization just generally across the region, so there's been a lot of challenges in certain jurisdictions where data is not allowed offshore. That can create problems for cross-border trade, particularly for international firms that use data and centrally process it. Understanding at the same time that governments do want to protect data and protect consumer privacy, but at the same time, I think the challenge there is working with those regulators to understand what are their ways to achieve the same outcomes without actually prescribing technical solutions. Sustainable finance. So we've been working a lot around sustainable finance and differences around that. Another area that we've been focused on is around EU benchmark reform. So that's very challenging for a region like Asia. There are 3 different routes for that: equivalence, recognition, endorsement. I guess the short story there is there's not been a lot of qualification of non-EU benchmarks, and that's a challenge, both in terms of preparedness of the industry, but at the same time, those routes are very challenging. We've been dealing with the European Parliament and the European Commission to understand some of those challenges, and we continue to engage on that front. And finally, Hong Kong. So it's blank. That's a picture of tear gas on a particularly bad day. We've been working on Hong Kong. We've been working with HKMA and SFC around business continuity planning. So there's been no considerable capital leaving Hong Kong as a result of the protests. However, we have been working with the regulators to understand some of the risk challenges. For example, if there was disruption to the markets, and working with the HKMA and SFC to understand the need for flexibility if, in the hopefully unlikely event that there are disruptions to the Hong Kong market, what is needed in terms of keeping the Hong Kong market running, what is the flexibility required from a regulatory perspective to allow offshore activities to be done offshore, for example, or if people are licensed to do things from a particular premise, that they can do that from home, etc. And also, what are the requirements needed and engagement needed with other regulators around the region to work with the regulators in Hong Kong to keep the market open. So that's all my updates. So thanks very much. I think I've gone over time, so I've set a very bad precedent, so apologies for that. Thank you.
Thank you so much, Mr. Chen, for being in line with the timeline, especially. Our second presenter now is Mr. Mushtaq Kapasi from ICMA, International Capital Markets Association, Asia Pacific Representative Office. Thank you.
Hello and good morning. Well, thank you very much to the host, PCMA. It's been a wonderful day, wonderful conference. And thanks to you all for your time and attention. Let's get right into it. So my presentation this year, okay, well, overview of ICMA. We are the International Capital Market Association. We are an international trade association focused on the cross-border markets, not necessarily the domestic markets, although we work very closely with all the domestic associations, focused on the cross-border markets and focused on the debt securities markets. So we're not as focused on loans, derivatives, or equities or FX, really focused on the debt capital markets. My short presentation this year will focus on the transition from LIBOR and risks for the international bond market. If you look at our written report submitted for the ASF this year, we cover this topic in much more detail, as well as some other topics that are relevant to this group, such as Brexit and fragmentation on the capital markets, green and sustainable market developments, and European regulations that may affect Asian securities markets, in particular the CSDR, Central Securities Depositories Regulation, and the SFTR, the Securities Financing Transactions Regulation. Again, more details on these in the written report, or you may ask me at any time. ICMA's position is that market participants should prepare for the potential non-existence of LIBOR after 2021. And it's a good chance to be reminded why LIBOR is being discontinued. Of course, we're all aware of the conduct issues, but those are largely addressed now, and that's not really the reason. The main reasons are, one, that there just aren't that many transactions actually underlying LIBOR today compared with the exposure, and secondly, that the process for determining LIBOR is very much a pyramid. There are a small number of participants who are quoting LIBOR, and that affects trillions and trillions of dollars in investments, including billions in bonds and cash loan markets. You can get an idea for the amounts involved here on this slide. I want to also share some recent numbers that I've gotten from Bloomberg that are more regional in nature. According to Bloomberg data that we've received, more than $65 billion of Asian floating rate notes are maturing from 2022 onward, 270 issuances. And that's in addition to $150 billion in Asian syndicated loans maturing from 2022 onwards. So these are not ones that are maturing right now. These are ones that are maturing after LIBOR is going to be discontinued. So the challenges are very stark there, even in Asia. So what should issuers do now to avoid the risks related to benchmark transition? Well, we recommend that new issuances be linked to the risk-free rates that are replacing LIBOR, and that's SONIA in the UK, and that's SOFR in the US. Now, just to summarize very briefly, fortunately, in the sterling market, generally speaking, the issuances now are referring to the risk-free rates to SONIA, and sterling LIBOR notes have generally been discontinued. However, in the US dollar market, and especially in Asia, we're still seeing a large amount of US dollar LIBOR-linked issuance, in addition to the risk-free rate-linked issuance for SOFR. So what I like to do personally to help me get a framework for this problem is to divide LIBOR-linked notes into three categories. The first is those maturing before 2021. So LIBOR will exist then. That's not much of a problem. We don't have to worry about these as much. The second category is new LIBOR-linked bonds that are issued now or after 2017 when the market became aware that LIBOR would end. And these generally include fallbacks to a risk-free rate, especially the ones that are linked to USD LIBOR. Now they have SOFR as a fallback. The ones that are linked to sterling LIBOR, of course, there aren't that many anymore, but those are generally have SONIA as a fallback. And new EMTN programs that have multi-currency issuance options usually have robust fallbacks. At least they understand that LIBOR may cease to exist. And in the US dollar LIBOR market, the ARRC, which is the Alternative Reference Rates Committee, has produced standard fallback language for US dollar LIBOR floaters. This is generally being used in the US dollar market. We're not really sure how much it's being used in the Asian market. Okay? But it's important to note that this new fallback language is only going to be useful in the new issuances that actually have the fallback language in it. What about those bonds that were issued before 2017 when nobody knew that LIBOR would end? This is the real problem. And market estimates indicate that legacy bonds referencing LIBOR maturing beyond 2021 are at least $864 billion globally. Most of these are denominated in US dollars, with the rest being sterling and other currencies. And most of these will fall back to a fixed rate if LIBOR is discontinued. Because basically what the bonds say is if there's not a floating rate that's available on a particular day, you just use the same rate and use the same rate and use the same rate until that floating rate comes back. Well, what if the floating rate never comes back? Then you've basically got a floating rate bond that's converting into a fixed rate bond. This clearly gives rise to potential commercial and even litigation risks, and we're seeing that already happening. So amending legacy bonds is a big problem. It's very difficult. Unlike loans, which are bilateral, or derivatives, or potentially syndicated, or derivatives which are bilateral and can be amended en masse using a protocol or other technologies, bonds are much, much more complicated to amend. And we at ICMA are very hard at work trying to figure out ways to make this easier. We haven't really come up with a solution yet, so basically what we're trying to do is just educate the market about the difficulties and the need to be aware of this issue. Just to close out, I do want to mention there are some bright spots on the horizon. There have been some legacy bonds that have been amended successfully, one particular case in the UK and a couple more in the pipeline. This is through a consent solicitation process where the issuer goes out, polls the entire community of investors, and gets consent, either a supermajority, like 75% in British law context, to amend the bonds. However, amending the bonds is very, very difficult in practice. And if that's not possible, what are the other options? Well, you can either buy back and reissue new bonds. The authorities in Europe may actually allow issuers to still use LIBOR even though it is discontinued. It may still continue to exist for purposes of legacy contracts. Or the final option, unfortunately, is just to let the bonds operate according to their terms and revert to fixed rate, even if this was never the investors' or the issuer's intention at the beginning. And in closing, I'd like to mention that there are other risks related to the transition from LIBOR in the bond markets, risks of hedging mismatches, recharacterization risk of capital instruments, which have capital requirement implications, regulatory reporting requirements, and even potential mis-selling or conduct risks for investors who may not have been aware of the potential for the economics to change in these bonds. It's very important to consider these potential risks under all circumstances, and we at ICMA are able to give informal guidance on these. Thank you, and we look forward to speaking with you for the rest of the conference.
Thank you, Mr. Kapasi. Okay, next, I would like to introduce Mr. David Lynch from AFMA, Australian Financial Markets Association.
Just next is here. This one is, yeah. Oh, yeah, okay. Good morning, everybody. I'm delighted to present the country report for Australia. The details of the country report are made available to you separately. So I'll encourage you to look to that for detail in terms of some of the issues I'll mention here. I'll focus primarily on developments in our markets that we think are of interest and relevance to the audience. In introducing our markets, it is important to refer to the economic context within which they operate. And in short, as you can see from the chart, Australia's had a sustained period of economic growth, 28 years. But we have reached a point where growth is softening, although we think that may improve going forward from here. In addition to that, Australia, like many other economies, is faced with the issue of low inflation and low wage growth. It's not unique to Australia, but it's an issue which does have an influence on the evolution of our markets. In particular, I also want to mention the nature of our capital account that's evolving. And in the chart that you see presented, I would just mention, if you look at the equity investment, you'll see that Australia is a net equity exporter. Therefore, for markets in the region, there's an interest from Australian investment funds and others in looking at potential there. Anyway, so given the relatively soft economic conditions that we've been looking at, the consequence of that has been reductions in interest rates. We've not reached the point of negative interest rates, and we don't think we'll reach that, but nevertheless, interest rates are very low relative to what they would have been in the past. One of the impacts of that is that it's increased the attractiveness of investments in the share market, and you can see after a difficult start to the 2018-19 year that the market recovered quite significantly over the course of this calendar year. A number of reasons behind that, and many of the factors driving the uncertainties relate to international trade, which again would be common to many other markets. Focusing on our equity markets, there's a couple of points I think are interesting to note. One is that the market capitalisation in terms of GDP has been steady, in fact increasing since 2012, which we think is a good outcome. And also you can see from the second chart, the bar chart, the number of tech companies listed on the stock exchange has been increasing, and the number of foreign companies listed on the exchange have been increasing. And pleasingly, from a markets perspective, ASIC, our regulator, reviewed the markets for cleanliness. In other words, the integrity of the market was checked, and the outcome of that in the report issued this year was very good. It said the market was performing well and it stands well in comparison to its peers internationally. So a lot happening in the equity space and a lot of relevant development. In terms of green and social sustainability bonds, I've included in the report a little bit of information about this. It does feed into some of the discussion that you'll have later about ESG issues and the UN initiatives in that area with the SDGs. But you can see that there's been a fairly strong increase in interest in green and sustainable bonds. This is really driven by investor mandates, which are looking for opportunities to invest. So modest, but growing quite significantly. And in a regional context, the Australian markets perform above the weight. China is obviously the market with the most significant market in that context. Okay, let's move on to industry developments. And there's a couple of points here which I think are interesting that I'd like to refer to. First is the Royal Commission into Financial Services, which was commissioned in November 2017. The report was delivered in February this year, and it has a profound effect on markets in Australia and on the industry in Australia. It is the report and the Commission looked very closely at retail banking and insurance services, but the implications affect all parts of the financial sector. The particular focus is on culture and values and conduct and how they must be managed most effectively going forward. The emphasis is on treating clients fairly and operating in client interests. So there is a significant reform program underway consequent to that. Following on from that, but related to it, there's a significant work underway in relation to industry professionalism. This commenced quite a number of years ago, so it's an ongoing process, but in the context of the Royal Commission, it's got heightened importance. And the focus of the work there is on the professionalism of the individuals in the industry, but also the industry conduct standards that bodies like AFMA set to guide appropriate behaviour in markets. Interest rate benchmarks has been mentioned already by Matthew and Mushtaq. Just mentioned here, Australia is a bit different from Europe and the US in the sense we will have a multi-rate benchmarks system going forward. So we'll have risk-free rates, and we have already had bond issues that reference the risk-free rate, but we will also be maintaining a rate which is, in a traditional LIBOR sense, something like current credit and term attached to it. And that's a feature of many Asian markets, so quite different to what you see in Europe. Market infrastructure and technology, yes, a very important point. Like everywhere, cyber risk and information security is a focal point. So I really don't want to talk about too much detail because I think that will be addressed in panel sessions this afternoon. And also, finally, to mention that the government has launched a retirement incomes review, which is very important in the context of the issues we look at in dealing with an ageing society and how you sustain people as they enter old age in good living standards and conditions and deal with the risks associated with that. Finally, in closing, I'd like to thank TCMA, who have agreed to host the ICSA interim meeting tomorrow afternoon after the Asia Securities Forum is completed. Thank you for that, and also thank you for all the delegates to ASF who've made the visitors from the other non-Asia ICSA jurisdictions very, very welcome. That's really appreciated. The region is very exciting, so it's great that they have the opportunity to see and understand some of the developments there in some detail, and I hope you enjoyed the opportunity to engage with them. Peter Eisenhardt, the Secretary General of ICSA, is here. He's speaking on a panel tomorrow, so if you have any questions about ICSA, please speak to Peter or myself. I'll be very happy to engage with you on that. Sorry, I borrowed a half a minute to talk about ICSA at the end, but I just did want to acknowledge and give with gratitude the hosting and the welcome that's been given to people here. Thank you.
Mr. Lynch, thank you. And we follow up with Mr. Dennis Su from Chinese Taiwan Securities Association, CTSA.
Good morning. I'm very pleased to meet everyone in Istanbul and to present to you the important issue of the Taiwan capital market in this year, as well as the future for the security industry. The GDP in Taiwan in 2018 was 2.6%. In 2019, the economy has been in moderate growth, benefiting from the diverted order and the shift of the Taiwanese phone supply chain in mainland China. On top of that, more and more Taiwanese companies go back to Taiwan and increase their investment in homeland, helping the overall investment to expand. This year, Taiwan economy growth is expected to pick up quarter by quarter. The GDP is estimated to be 2.46%. Taiwan Stock Exchange Index has stayed in between 9,300 to 11,000 points this year. The PE ratio of the Taiwan stock market is 12.74. The PB ratio is 1.51. The average daily trading value in 2018 was $5.51 billion. The average daily trading value in first half of 2019 is $4.96 billion. Market capitalization was $103 billion, and the total value of the stock trade on the centralized market was $58.87 billion. The volume of the trading was 35.87 billion shares. Currently, Taiwan Security Association has 129 members company. There are 71 security firms and 58 companies can currently operate the security business, such as the bank, beer, finance, futures, and others. The initiative this year in our security market, including issue ETN, futures warrant, introduction, cornerstone investor in IPO market, and the launching preliminary regulation governing security token offering. Furthermore, the Taiwanese government is actively promoting investment in Taiwan. Taiwan has recently passed the call of the management, use, and the integration of the returning offshore fund. The Overseas Fund Repatriation Separate Act has been put into implementation since August 15, 2019. It's estimated that the more than $10 billion will be repatriated to Taiwan in the next 2 years for real investment, likely to boost the domestic demand and help to maintain economic growth momentum. The Overseas Fund Repatriation Separate Act provides a new channel for the Taiwanese company in the name of the individual or enterprises to repatriation fund deposit in overseas. According to the Act, fund repatriation from the overseas in 2 years can benefit from the preferential tax rate of the 8% in the first year and the 10% in the second year. If the fund can put into the real investment, the tax rate can be further reduced to 4% or 5%, as long as the fund can deposit in a special account for a certain number of years, compared to the general overseas income tax rate of the 20%. The Act offers favorable tax benefit. For the use of the fund, the way in which fund can be used during the time frame are limited, of which 5% can be used friendly, 25% can be used in the financial investment, and the remaining 70% can use in the real investment, but not in the real estate. There are 3 ways for real investment in the regard. The fund can be used in their own business, in setting up the new business, or in increasing capital of any other profit-seeking business. In the second and the third case, investor must be hold share of the investee for more than 4 years. For financial investment, investable target including the government bonds, corporate bonds, and the financial bonds, international bonds, stock, fund, ETF, ETN, and the other domestic securities. The fund can be used to buy and sell listed stock and the warrants, and to trade in the futures or option for hedging purpose. In addition, individual can also buy the life insurance and the insurance product within the 3% limit of the repatriation fund. In June of 2019, the Financial Supervisory Commission in Taiwan launched the preliminary regulation governing STO. In the future, the FSC was adopted tier supervision with the fundraising amount of the $1 million as the limit. STO over $1 million is required to enter the sandbox experiment. Once the sandbox experiment is successful, the Security and Exchange Act will be applied. Furthermore, in the case of the fundraising scale under the $1 million, the FSC also stipulated the target must be professional investor. And the gateway for a professional investor is at $10,000. The FSC will continue to make the modification around the way, hoping that the more restriction can be relaxed after 1 year of testing. STO trading platform operators are required to obtain the license for proprietary trader with the minimum paid-up capital of the $3.33 million and the operating bond about $330,000. Meanwhile, for a single platform, the total amount of the fund raised by all issuers cannot exceed $3.33 million. Additionally, a single platform can accept the issuer's second STO only after his previous STO transaction has been complete for 1 year. On the other hand, in order to control the risk of the money laundering, STO subscription and the trading adapter, the real name system, and are limited to outward remittance and deposit in Taiwan dollar by bank account with the same name. As the financial market keep evolving and the security firm business keep developing, the Taiwan Security Association has been engaged in the increasing affairs to accomplish the future goal and to further promote business development. The association has gone through organization adjustment, ending up with the 5 business development division and the 2 association affairs division, aiming to expand the development of the capital market and to boost the competitiveness of the security industry. The association will striving for expansion of the 3 major security business: brokerage, proprietary trading, and underwriting. With our striving, we expect to see boost the direct market, direct finance, self-design financial product, import substitution, and employment growth. Hoping that one day Taiwan will become Asia Wealth Management Center. Thank you for your attention. May you be blessed with a good health and good luck. Thank you.
Okay, we are continuing with Mr. Anup Khandelwal from Association of National Exchanges Members of India, ANMI.
I bring you greetings from India. At the outset, I wish to thank ASF for giving us opportunity to present before you the country report. Today, India is an emerging economic power with a global presence, showcasing its enormous domestic market. We are reaching out to all countries to partner with us in this growth story, an established path set up by our government. But before I share with you the Indian growth story, let me share a few words about ANMI, Association of National Exchanges Members of India. ANMI is one of its kind association comprising of trading members from different exchanges, thereby servicing as a national platform and contributing to the economic development of the country. It has a pan-India presence with 900 plus members from various exchanges. It provides a healthy platform to its members to interact regularly with each other and bridges the gap between regulators, exchanges, trading members, and participants. We associate with various international organizations like ASF, ICSA, AFIE, etc. and are regularly invited by Ministry of Finance, Government of India to take inputs and views on various significant issues of capital market. Let me now share with you a snapshot on Indian economy. India is the world's 5th largest economy by nominal GDP and the 3rd largest by purchasing power parity. From 2014 to 2019, India was the world's first fastest growing economy with a growth rate of 7.5%. During 2018-19, merchandise export from India have increased by 8.85% on year-to-year basis to $298 billion, while services exports have grown by 8.54% on year-to-year basis to $185 billion. India is significant in many ways. We are the 6th largest manufacturer, representing 3% of global manufacturing output, employing 57 million people, and nearly 60% of India's GDP is driven by domestic private consumption. In the long-term growth perspective, Indian economy rides the crest with its young population and corresponding low dependency ratio, healthy savings and investment rates, and is increasing integration into the global economy. Talking about the recent growth in the Indian capital market, the Demat account in India is now at 36.5 million, logging a CAGR of 9%, CAGR growth of 9%. AUM of individual investors grew from $57 billion in March 2014 to $200 billion in June 2019, logging a CAGR growth of 27%. AUM of institutional investors grew from $61 billion to $145 billion, showing a growth in CAGR by 18%. In terms of total market capitalization, the two leading stock exchanges, BSE and NSE, had a growth of approximately 11% and 22% respectively in the 5-year. Individual folios in mutual fund have grown from 39 million in March 2014 to 83 million in June 2019. FDI inflow in 2018-19 remained strong at $63 billion, making a 6% growth over the previous year. Whereas, as global FDI flow slid by 13% in 2019 to $1.3 trillion from $1.5 trillion in the previous year. The third consecutive annual decline, according to the World Environment Report 2019. Over 600 new FPI registers with Security and Exchange Board of India in 2018. The steepest rise in FPI count since 2014. There are now 9,246 FPIs active in the country. Now let me highlight the opportunity galore. As of financial year 19, approximately 2.5% of Indian citizens are directly or indirectly linked to the capital market, whereas this figure is around 54.5% for USA and 50% for China. Low interest regime is pushing more people toward capital market as it offers attractive return. Recent cut in corporate taxes by Indian government will help India to explore many new businesses and investment opportunities. Government reforms like goods and service tax, Make in India, Digital India, Jan Dhan Yojana, and other economic reforms have helped India to hold 63rd rank in the World Bank Ease of Doing Business 2020 survey. Blockchain and artificial intelligence have brought in efficient and fast trade, simplified and redefined business models. Continuous structure and regulatory changes, consolidation of PSU banks, and introduction of Indian bankruptcy courts ensure a stronger and transparent economy. Government initiative like GIFT City Ahmedabad, India's first operational smart city, and International Financial Service Center have allowed more people across the globe to come and start business in India. India has more than 50% of its population below the age of 25 and more than 65% below the age of 35, which opens the gate for newer hand in the capital market. Government aim to grow to $5 trillion economy by 2025. If the current growth rate sustained, it is expected we will be the 4th largest economy in the world 2022. Now coming to the challenges. The knowledge on commodity and currency market among the people is quite low. While commodity market have been growing at a rapid pace, there are major limitations for various investment classes for retail investor. Future holds promise as in removal of these hurdles are in progress. On the currency front, the segment has also witnessed consistent growth, but a lot many opportunities still remain unexplored. In well-developed economies, bond market are larger than equity market. Indian story is opposite. Bond market is still at a nascent stage. To harness this opportunity, the government is working hard to generate domestic demand and improve debt market infrastructure and regulation regularly. Lack of skills and knowledge with regard to finance and capital market poses a major hindrances. To overcome it, regulators of the financial market enemy are working hand in hand to spread basic financial knowledge. I request you all to come and partner with us in Indian growth story. We from NME will be more than happy to support and shoulder partnership for tomorrow. Thank you. Thank you.
Thank you, Mr. Khandelwal. And now we continue with the Bombay Stock Exchange Brokers Forum, BBF.
Good morning, ladies and gentlemen, and thank you, TCMA, for hosting all of us and making such wonderful arrangements, and yesterday's belly dance in particular. My name is Anurag Bansal, and I am representing Bombay Stock Exchange Brokers Forum India, or BBF in short. My friend from NME has already talked about India, so I'll try to be non-repetitive wherever possible. India grew at 7% in calendar year 2018 and is expected to grow at around 6.2% in 2019. Though the growth rate is moderated, though we are not very happy about this, but the fact is that we are still growing at double the rate at which world is growing. In FY19, or year ending 31st March 19, India attracted FDIs flows of 30.7 USD billion, which majorly went to services, automobile and chemical sectors. FPIs, on the other hand, were cautious and sitting on the fence, with net investments from them being near to nil. But in the last 6 months, FPIs are back with net investments of USD 7 billion. Another development that has happened in last 1 week is that India has improved its ease of doing ranking from 100 in 2017 to 77 in 2018 and now 63 last week. Friends, this is an interesting chart. Returns in equities markets have been volatile, and that is the nature of the market. BSE benchmark index, that is S&P BSE Sensex, delivered 17% return in FY19, with the market capitalization reaching to USD 2.2 trillion. But what is important to note that the mid-cap and small-cap stocks could not match the pace, as BSE mid-cap index delivered negative 3% return during the same period. What I'm trying to say that, though the rally in the Indian main indices continued during the period, but the same was not broad-based and was limited to a few major stocks out of total 5,000 stocks listed on stock exchanges. Fundraising through new issuances also had a tough time, as it came down by nearly 80% in FY19 as compared to last year. Companies could raise only USD 16.3 billion in FY19 only 2.6 billion in FY19 as compared to 16.3 billion in last year. In spite of all this, SME platform of the stock exchanges witnessed some action with 110 issues raising around 265 million. Asset management industry in India is steadily rising, thanks to the culture of systematic investment plans, or SIPs, inculcated by asset management companies and industry through regular and aggressive awareness campaigns. Today, our AMC AUM stand at around USD 370 billion, with more than 40% in equity schemes alone. Coming to the topic of my focus, NBFCs. In India, nearly 25% of the lending or credit is taken care of by shadow banks, or more structurally called non-banking finance companies, or NBFCs, which are regulated by central bank. As the credit of traditional banks was growing at 10% YOY during last couple of years, NBFC's book grew at 20%, a phenomenal rate of 20%, and it more than doubled in last 4 years. So let's look at the factors that had contributed, that were the key drivers for the growth of NBFCs. India is a vast country with 640,000 villages, 330 cities and towns, population speaking more than 700 languages. NBFCs played an important role by reaching to each and every corner of the country where traditional banks could not reach. Apart from that, they had deep understanding of the customer segment, as they were many a times locally based. They could offer customized products as they had that kind of regulatory flexibility. Of course, wider and effective reach, as I earlier mentioned, and robust risk management, which is under cloud as of now. Co-lending arrangements with bigger banks was very, very successful. And finally, technology, which helped in procedures, risk management, approvals, and faster disbursals. FY19 has put a brake in the growth of these shadow banks, with one of the largest NBFCs defaulting in October 2018 and followed by few more. Growth has reduced to 14% in FY19 as compared to 20% earlier, and it is expected that this will reduce further with a few more banks under a lot of stress, and many banks have stopped fresh lending. Some of the reasons that contributed to this crisis are higher dependence on off-roll sales force, which had minimal accountability and that impacted asset quality. There were gaps in underwriting model, right from experience of underwriter to taking risky bets to boost the credit book. Again, to increase the book size, products were offered with limited knowledge in the local context, and that impacted quality. And lastly, and most importantly, short-term borrowings were used to offer long-term lending. So many of the NBFCs today are not fighting with the issue of asset quality, but with the issue of liquidity due to asset liability mismatch. Even after all this, we believe that NBFCs will continue to play important role in credit dispersal in India, though the near-term challenge is pain is supposed to continue for some more time. Central Bank have also woken up to the issue and is ready to strengthen the regulatory framework around NBFCs to make them more financially resilient and robust. I wish that we'll be able to showcase a better picture of NBFCs when we meet next year at ASF AGM 2020 in India. Thank you.
Thank you so much. It was perfect timing. Okay, next we will hear from the Association of Indonesian Securities Companies, APEI.
Okay, this one for the skin next. This one, next one. Okay. Hi, good afternoon, all the participants. So I have 6 minutes. So we have before we have a lunch. Okay, my presentation is divided by 3 parts: economic of glance, capital market performance, and also opportunities and challenges. In economic at glance, I will show the GDP growth, GDP breakdowns, and also inflation and employment rate. GDP growth for past few years is almost the same. It's about 5%. So I think our economy in Indonesia is quite stable at that time. And then I can show you that our GDP is supporting by the consumption. We have a big population, 260 million people. And also the government for the last few years, they boost the infrastructure. They built a lot of toll road and also a lot of toll port to connect all the cities in Indonesia. You know, Indonesia is a big demography. We have 1,000 islands. So the new government, they make connection to reduce the logistic costs to attract the direct investment to come to Indonesia. So this is the inflation and unemployment rate. I want to show to you this. Unemployment is decreased, but I will give you the highlight because the unemployment because the disruptive economy and also digitalize for the, now a lot of new technology come to our country. So this interesting, like a lot of apps, they will launch already in Indonesia for delivering food and something like that. So unemployment decreased for the senior high school. So they work for the just for the delivery food. So they make a food. But the problem is unemployment is increased for the university graduation because some part of the company they take over by the digitalization and also the robot. So I think tomorrow we will have a nice topic, interesting topic, because we will discuss about the digitalization and impact to the capital market. This is the capital market performance, and divided in 3 parts: stock market, bond market, and mutual fund market. Stock market, this is the volume and the value of trading for the whole year is most likely stable comparing to the last year. And this one is every average day transaction. We slightly decrease lower than last year because last year we have a presidential election. So some investor, they wait and see, so they will get the result. And this year, the president was launched last month to become, they make the new government for the next 5 years. This our market capitalization is slightly almost the same. So the index, because of that I mentioned before, we have election last year, so slightly lower because some investor they just wait and see. They will see the new government. This is interesting. There's a listed company in Indonesia is still growing up. For example, for this year, we have a listed company. The new listed company is around 75. Last year is 68, and the target for next year is 75 also. It's interesting because we encourage to some company to be listed because the government give the incentive for the tax, for the founder, for the shareholder. So a lot of company now, they interest to become the listed company. This is our stock market investor. That I can show you that a lot of our investor now below than 30 years old now become more than 50% become our investor. This is very important because our population is so big. So also we have to change some regulation and our strategy marketing to handle the young generation because they always depend on the application. So the regulator and association, we have already set up for example, for opening account, we make a digitalization opening account, and also with the central custodian, we set up for the e-proxy and e-voting for the annual general meeting, and also now we will launch the iBook building, electronic book building for the IPO. So investor doesn't need to go to the bank to apply the shares. So that's bond market, corporate and government bonds. That's slightly almost the same. So because the time is up, I will show what we have done this year. We make the settlement from T+3 to T+2. That's very successful. We make it a lot of effort to do this. and our goals and our main goals is how to increase the transaction because now the settlement is shortly than before. There's a summary of the capital market. Okay, I will skip. The challenges: low liquidity of the market. We feel that our potential is so big, but we feel we can increase the liquidity of the market also. And the product also is, we need more. It's not just a plain vanilla product. So we create some new product for the hedging, for example. And brokerage and underwriting fee competition is very, very tight now. As you know, I think it's around the world. Since a few months ago, like I make a sample, Charles Schwab from US, they announced that now the commission is 0. So there's a challenge also for the securities company in Indonesia, how we handle it about the competition of the commission for the transaction. So that's an opportunity for the next, I think time is up. So maybe after that, if you have a question, we can discuss later on. Thank you very much.
Thank you, Mr. Budianto. And next we'll be hearing from Mr. Mohammed Husseini from Iran Securities and Exchange Brokers Association.
This one? Okay. Okay, thank you very much. First of all, I want to thank TCMA for having us, and thanks all of you for having and hearing me. Let's start. Let me start my presentation by telling you about Iran GDP. As you can see, Iran had an estimated GDP of $454 billion in 2017. Iran's GDP is 0.7% of world's economy, and the highest and the lowest figures for Iran GDP belong to 2012 and 1965. In 1965, it was $6 billion, and in 2012, which was the highest GDP ever recorded, was approximately $600 billion. I would also like to mention which part of the economy has the highest share in the GDP. That is the service sector, with the highest, followed by oil production with 23%. GDP annual growth rate in Iran averaged 4.5% in the last 40 years. And the highest GDP annual growth rate was 16.8%, which was in 2017. About population. As you see, population in Iran is increasing gradually. The estimated population in Iran is 82 million people. It should be considered that Iran has approximately 1.1% of the world's population. In the last 2 decades, unemployment rate in Iran averaged 11.7%. And currently, unemployment rate is below the average rate for 20 years. One of the most important issues in current situation of Iran's economy is inflation rate. At present, inflation rate in Iran declined to 42% in August 2019 from 52% in April. Exports in Iran reached to approximately $30 billion in 2018, and it should be mentioned oil and natural gas are Iran's most important exports, which are 80% of country's export revenue. The most important Iran's partners are China, Japan, and Turkey. 21% of the total exports is to China, and followed by Japan with 9.2% and Turkey with 9%. Import in Iran averaged approximately $30 billion from 1974 to 2018. As you see, and it's obvious, sanctions had a great influence on Iran's economy. So imports dropped dramatically in 2018 from 22.8 to 16.3 billion US dollars. If you want to know which were the most important imports of Iran, I can tell you that it's non-electrical machinery, iron, and steel. The most important part of my presentation is Iran capital markets challenges. Iran capital market is faced with serious challenges. Sanctions are partly to blame for them, and also the huge cash flow, which is acting like a very destructive force. About market imbalance, Iran is experiencing a huge cash flow, which is moving such as property, gold, stock market, or even foreign currency exchange. This has led to an enormous instability each time this huge capital enters of these markets, and once this cash flow leaves that specific market, it faces recession. I mean that market faces recession. For example, last year, the price of property went through the roof in major cities in Iran due to this phenomenon of cash flow. Such economic fluctuations can lead to the investors' distrust and lack of confidence. In other words, they prefer to withdraw their capital from these investment markets and sometimes take them out of country in the hope of finding stable markets. And the next challenge for Iran's capital market is sanctions. The impact of sanctions have been mostly visible on export companies, which are struggling to find the customers and also return the money that made through their exports to Iran. These companies have also struggled with the shipping and insurance of their goods. The production companies are also having to deal with the lack of raw materials, or even if they manage to find the raw materials, they have to pay double or sometimes even triple the normal amount. And on the top of these issues, manufacturing companies cannot find ways to overhaul their production lines, or they have a hard time finding ways to facilitate their maintenance. And I'm finished. Thank you.
Thank you, Mr. Hosseini. And our last presenter for the day, for the midday actually, is Mr. Takahiro Nojima from Japan Securities Dealers Association, JSDA.
Okay, thank you again, TCMA colleagues, for giving me this opportunity. I'd like to brief you on the recent development in the Japanese securities industry. I don't cover everything in detail, but let me just take a few minutes to provide you with a better picture of the current status of the Japanese capital market. In June this year, as you are all probably aware, the G20 summit was held in Osaka. Several challenges related to the securities market and the industry were raised there. Most notably, matters relating to the population aging, market fragmentation, and technological innovation. Japan is widely known for its rapidly aging society, and as such provides a unique space for ideas to tackle this issue, especially in the field of finance. For instance, Japan introduced a tax exemption scheme for small amount of investment called NISA. NISA is a tax exemption scheme for a small amount of investment. And NISA stands for Nippon, meaning Japan, Individual Savings Account. And it was modeled after the ISA of the UK. Currently, the number of accounts opened is more than 30 million, and over 60 trillion Japanese yen are managed in those accounts. Through these kinds of taxation schemes, Japan is working toward ensuring individual long-term diversified investment so that people are better prepared financially for their expected 500 years of life. Consequently, Junior NISA was introduced in 2016, and dollar cost averaging NISA was introduced in 2018. Dollar cost averaging NISA was designed for long-term moderate risk investment in order to support asset building for people's later stage of life. Unfortunately, these NISA schemes are temporary schemes. So making them permanently is one of the most pressing challenges right now. And also, I want to raise this issue. Financial gerontology. Financial gerontology also recently attracted attention. Some major financial institutions in Japan established some entities relating to financial gerontologies. Some major examples of this include the Research Center for Financial Gerontology at Keio University and the Japan Financial Gerontology Institute, which is an industry-led think tank. Through these organizations, the securities industry have been working to look more in depth into the potential impacts of and response to the aging society. On the issue of market fragmentation, in May this year, the Japanese financial industry submitted its views of market fragmentation to G20 leaders under the name of the Study Group on International Financial Regulation. This paper identified 4 main causes for market fragmentation, namely discrepancies, overlaps, desynchronization, and competition. On the contrary, if we look at the Japanese domestic securities market, it is not fragmented, and trading are heavily concentrated in Tokyo Stock Exchange. Therefore, regulatory framework was recently reformed to allow securities firms to provide the customers with margin transactions at alternative trading venues in order to stimulate competition among securities trading venues. While this is not directly related to market fragmentation, but I'd like to now take some time to introduce you to another development in Japanese securities market. To reduce systemic settlement risk, the settlement cycle of persona of financial products have been shortened from bonds to stocks. Of note is that in June this year, settlement cycle of stocks was shortened to T+2. As a result, all securities listed on stock exchanges in Japan are now settled within 2 days after trading day. Lastly, I'd like to paint a broad picture of the current environment of financial technological innovation. In Japan, many fintech businesses have been thriving, same as the other part of the world. Some of them facilitate small amount of investment, which helps long-term asset building by general public. And looking at regulatory framework in Japan, initial coin offering are regulated by Payment Service Act because it is seen as a type of payment method. On the other hand, securities token offering, STOs, is to be regulated by the Financial Instrument and Exchange Act, which regulates conventional securities as well as Japanese securities law. securities transactions using blockchain technology, for example, blockchain bonds issued by the World Bank, are to be overseen by the JSDA as a self-regulatory organization. Meanwhile, the question of who will be in charge of overseeing the transactions of collective investment schemes using blockchain, so-called STOs, are currently under discussion. That's all from me, and thank you for your kind attention.
Thank you, Mr. Onojima. And we thank all our member presenters for their precise work and definitely being in line with the time schedule. That was very important, and thank you. And now the good news. Lunch is ready. You can go to the R floor, and the name of the restaurant, as far as I remember, it's Panorama Restaurant. Please enjoy your lunch, and we'll be back at 1:30 sharp for the second part of market reports. Enjoy, bon appétit.